Okay, let's dive into this. Welcome to today's Explainer, where we're breaking down what is honestly one of the most polarizing and kind of fascinating operational shifts we've seen in recent tech history. We're talking about Ryan Breslow. He's the billionaire founder and CEO of the Fintech giant Bolt, and he recently made the highly controversial decision to completely eliminate his entire human resources division. Yeah, you heard that right, zero HR. It's a bold, aggressively lean move that has sent absolute shockwaves right through Silicon Valley. Today, we're going to look at the data to understand exactly why this happened.
To understand the spark that really ignited this whole firestorm, we gotta look at Breslow's own words. He publicly claimed that Bolt's HR department was, in his view, creating problems that didn't exist. He actually went a step further, stating that a lot of those internal issues simply vanished the moment the department was removed. Now, looking at this neutrally, this statement triggered an immediate and massive debate. Across the tech community, you've got fierce backlash. A lot of professionals view HR as absolutely essential, for legal compliance, company culture, and protecting employees. But on the flip side, there's quiet and sometimes very loud support from other founders who feel like modern corporate structures have just gotten way too bloated and bureaucratic.
Which brings us to the core question framing our explainer today. Is this ruthless, or is it just the new normal? To truly grasp what's happening here, we have to look way past the localized drama of this single billionaire founder. This specific event at Bolt, it's actually a massive flashing indicator of a much larger global shift happening right now in private capital markets. We're seeing a fundamental change in how companies actually operate.
Section 1. The million-dollar cost base. Moving away from the founder personalities and the flashy PR headlines, we need to transition into the cold, hard math of what late-stage fintech operations actually cost. Because, at the end of the day, the numbers are what drive these decisions.
Now, what's really interesting about this slide is just the sheer scope of a modern HR department. It's totally staggering. When a late-stage fintech company scales up, it's not just a couple of folks cutting payroll checks and organizing the annual holiday party. You're building out executive HR leadership. You've got massive talent acquisition teams and highly specialized compliance staff. You're paying for complex software recruitment systems, retaining expensive legal consultants, funding internal training and culture operations, and maintaining an entire infrastructure literally just for benefits management. It is a massive, highly complex corporate machine.
And maintaining that machinery carries a huge price tag. For a billion-dollar technology company like Bolt, industry analysts estimate that running that large HR function can cost anywhere from $2 million to an estimated $8 million annually. $8 million! Depending on the scale and the geographic footprint of the company, that is an incredible amount of capital tied up purely in administrative and support overhead, year after year.
So the crucial point is, it all comes down to a really simple equation. Cutting overhead equals an extended cash runway, improved valuation, and much stronger investor confidence. Think about it. If a company completely removes a significant chunk of that $8 million infrastructure, they're dramatically slashing their operating expenses. And they're doing this during a critical period where investors are actively demanding tighter financial discipline. Every single dollar saved on overhead is a dollar that extends the company's lifespan ahead of future fundraising rounds or even potential acquisitions.
Section 2. Silicon Valley's lean era. Let's step back for a second and zoom out from the Bolt-specific story. We really need to examine the broader macro trend that is fundamentally reshaping the global technology industry and how corporate operations are structured today.
And this brilliantly illustrates the complete paradigm shift we're witnessing. On one side, we had the zero interest rate era. Capital was cheap, so the gold standard was aggressive hiring at all costs, building out these massive support departments and maintaining really thick, heavy layers of middle management. But contrast that with the new era. We're seeing a total shift toward lean operations, AI-assisted workflows that actually replace manual administrative tasks, and highly automated corporate structures. We are literally moving from a standard of growth at all costs to a brand new reality defined by aggressive cuts and AI replacement.
This brings us right to the new standard. And let me tell you, the demands for investors are urgent. They want smaller, highly capable teams, faster execution without those old bureaucratic bottlenecks, significantly lower burn rates. They want AI-assisted workflows taking over all that heavy administrative lifting, a massive return to product-first cultures, and above all else, operational profitability. For the financial backers of these tech companies, executing on these lean principles isn't just a temporary survival tactic anymore. It is absolutely viewed as a critical strategic advantage.
Because the fundamental rules for venture-backed firms, they've completely changed. Private capital markets have become way more selective and significantly more expensive.
The message from the market is getting increasingly direct. Growth alone is no longer enough. Efficiency is what drives valuations now. You can't just show a rising user count anymore. You have to prove that the engine running the company is highly tuned and incredibly cost-effective.
Section 3. The new Billionaire Playbook. Which brings us to our final takeaway. How are unconventional founders adapting to and honestly driving this new landscape? Well, we're seeing the rise of a completely new operational blueprint, one that challenges basically every industry norm we've known for the last decade.
Let's move to and see how this builds into the new Billionaire Playbook, which really rests on 3 core pillars. Step 1, remove friction. Just get rid of the internal layers that slow down decision-making. Step 2, preserve capital. You've got to protect your cash runway at all costs, especially when money isn't cheap anymore. And step 3, maximize execution speed. You have to move faster than the competition. Whether you agree with Breslow's specific methods or not, this blueprint clearly shows how billionaire-led startups are ruthlessly prioritizing execution over traditional corporate comfort.
So I'm going to leave you with this final provocative thought to ponder. Is the age of oversized corporate structures gone for good? As artificial intelligence continues to advance, as investor pressure for true profitability mounts, and as founders prove that hyperlean execution is actually possible, the balance of corporate power is permanently shifting. Think about what this means for the entire future of work. Thank you so much for joining me for this explainer, and keep analyzing the data.